Hi, welcome to this quick podcast talking about the accounting equation. Accounting in many ways is a very, very simple subject, provided you remember the basic rule. And the basic rule is there's always two parts in accounting. There's a debit side and a credit side. The debit side are all the assets of the business, and the credit side are the capital and liabilities of the business. And these two are always going to be equal when we look at the business as a whole. Assets basically are the resources that a business has to use, and I've given you some examples on a separate page that you can have a look at. But it's what the business owns and is going to use, for example, machinery. And these will normally be grouped together, so there's some headings down here that you can look at for ways that we group them. So, for example, if a business buys shelves, desks, tables, they wouldn't have a separate account for shelves, one for tables, one for desks, but they put them all into a fixtures and fittings account. Liabilities, that's basically the money that the business owes to other people. So, for example, to banks, to individuals, and capital. Don't worry about income at the moment. Capital, that's the money it owes to the owner of the business effectively, because that's what the owner of the business has invested in it. And I've put down here some examples. The big ones we need to worry about at the moment: mortgages. They're a loan that's against a building or possibly land, and obviously you know what a loan is itself. Okay, so when we look at the accounting equation, we know that our assets are always going to equal our capital plus our liabilities, what we owe. However, the other thing we need to be able to do is not only work out what our assets are, but also, given our assets and, for example, capital, what our liabilities are. So if we just look at the scales, if I want to isolate capital on its own, I need to take the liabilities off the right-hand or credit side of the scales, and also take the same amount off the debit side or the left-hand side of the scales. So what that then tells us is that capital has got to equal assets minus liabilities. And similarly, what we also know is that if we take capital away from the credit side, we've also got to take the same amount away from the debit side of our scales. So liabilities are going to equal assets minus capital. Okay, you've got to know these three forms of the equation. On the next page of the spreadsheet, I've put you some examples that you're going to do. Okay, but basically what you then need to do is to fill in the gaps. So, for example, here, if we know that our assets are 5,000, our capital is 2,000, then we need to work out our liabilities. And liabilities are assets minus capital. So assets, 5,000. We're going to take away our capital of 2,000, and that tells us that we've got £3,000 or $3,000 of liabilities. Here it's the assets that are missing. Assets equals capitals plus liability. So we need to do 10,000 plus 20,000, and that tells us that we've got assets of 30,000 in the business. And the final one that we're going to do is this one here, this gap, and it says that we've got assets and we've got liabilities, so we're trying to find our capital. Capital equals assets minus liabilities, so therefore it's going to equal 17,000, take away 9,000, and that means that we've got capital in this business of 8,000. Task was set for you. We've got a number of gaps here in this table. We've got liabilities missing, assets missing, capital, etc. What I want you to do is to calculate and put the correct figures into the gaps. What I also want you to do in this column, I want you to write down which version of the accounting equation you've used. So, for example, to do the first gap It's liabilities we're trying to find. Liabilities equals assets minus capital. That's the equation you should have used. And for the second one, assets are missing, so therefore assets equals capital plus liabilities. Okay, once you've done that, I've actually put the answers in there, so you should be able to find it. Okay, and then we're going to move on to doing a slightly more difficult exercise. If I can find it. Which is here. Okay, don't overdo it. This is something that you do need to learn quite quickly. Something called dead click. It's a rule to help you remember what we're going to debit and what we're going to credit. It stands for debit expenses, assets and drawings, credit, liabilities, income and capital. And there is another podcast on this, which you can watch pretty much straight after you've done this exercise. Okay, so first example here. Business has already got some motor vehicles worth $70,000. And it's also got cash worth $35,000. And what the business has done is it's purchased a new motor vehicle for $20,000. So quite clearly, the obvious one is we do need to increase the amount of motor vehicles in the business as an asset, and we're going to increase it by $20,000. And therefore, the business has now got $90,000 worth of motor vehicles. In this case, what the business has also done is going to reduce its cash asset. It had $35,000 cash, okay, but it's now used $35,000 of that cash up. Sorry, $20,000 of that cash up, and therefore they are left with $15,000 worth of cash. It's important to remember this: every single transaction in a business will affect two different accounts, or two different expenses, assets, drawings, liabilities, etc. There's always going to be two things which are going to be affected. Second example, business has got buildings worth $50,000 and it's got a mortgage already for $25,000 and it's going to buy another mortgage. So it's going to increase the value of its buildings by $100,000, giving it $150,000 worth of buildings, and it's also going to increase its mortgage by the same amount, so that's going to give them $125,000 worth of mortgage. So I've got an example here for you to have a go at, and that was somebody just coming into the room, not shockingly. I've got a business, we've got the opening capital, liabilities and assets, and the owners, first of all, is going to introduce a car that's valued at $5,000. And one of the things we are going to need to do, we're going to need to increase, number one, the amount of cars. We're going to increase that by 5,000. Okay, and we're also, because it's been introduced by the owner, we're going to need to increase the owner's capital. Okay, and what you notice here, to start off with, the business had $53,000 worth of assets, and it also had $21,000 of liabilities, and it had $32,000 of capital. And if we add those two figures together, 53,000, it's going to be the same as the value of the assets. The owner now decides, or the business now decides to buy a desk with a cheque for $500. Well, quite clearly, that's going to affect the amount of fixtures and fittings. It's going to increase them by $500. Something we notice straight away now is that the total of our assets and liabilities and capital are different. So we've got 58,500 of assets, but only 58,000 in total for the liabilities and the capital. So what we need to do, because he's buying it by cheque, that's going to reduce the amount of money in the bank. It's going to reduce it by $500. Hopefully, yes, it's worked. Okay, the amount of capital and liabilities is now 58,000, as is the value of the assets. Number 3, takes out a bank loan for $1,000 and is going to pay that into the bank. So we need to increase our bank loan by $1,000 because we now owe $1,000 to whoever we've taken the loan out from, whichever bank. However, the bank that we've got as our main account is going to increase by the same $1,000, and hopefully our assets still equal our liabilities and our capital, which they do. Business is next going to buy a printing machine for $1,500 of cash. So if we look up here, we've got machinery. They've already got $12,000 worth of machinery. So we're going to purchase another $1,500 of asset. And we're also going to pay for that by cash. So that's going to reduce our cash asset by $1,500. Okay, and again, assets do equal capital plus liabilities. And the final transaction, the business buys a laminating machine on credit for $750. So that's going to increase our machinery by $750. And if you look down here, they're going to pay on credit. A bit of a funny one there, okay, because they're going to owe somebody else some money. So we'll call that trade payables. Trade payables are people that we owe money to and that we've bought stuff from. And our trade payables are going to increase by $750. And again, we find that our account balance, so our assets equal our liabilities plus our capital. Got an exercise for you to have a go at next. So if you look on the next page of the sheet here, we've got an example for you to fill in. So business starts off with assets and liabilities, and you've got 7 transactions to carry through. Okay, again, I've put answers to those examples, so once you've done the examples and worked out what's happening in the business, then all you need to do is to check that against the answers provided. Thanks very much. I hope you've enjoyed it, and good luck with completing the questions.